2014 has been a fantastic year for all investors, whether it be bonds or stocks. Most have been surprised by the resilience of the Treasury market. The Treasury market in the United States has dropped in yield, up in prices throughout the year. As a matter of fact, through the end of August, the 10-year Treasury was up about 8%. That is wind in the sails, wind at our backs for high-yield bonds, convertible bonds, and equities as well. We've had a considerable number of headwinds. Geopolitical uncertainties, volatile earnings in some cases, although the second quarter was very good. We've had uncertainties around the economic outlook in Europe, of course, because of these geopolitical risks. But we know in the backdrop behind this continues a Federal Reserve in the United States, the government, regulators in all regions being very accommodative. Just recently we had more accommodation out of Europe. This sent treasuries further lower in yield, higher in price, and again, we've had very good results. If we focus specifically on the high yield market, the last couple of months have been turbulent. We had a significant pullback relative to 2014, a significant pullback, due to a number of technical factors. There were some outflows in mutual funds in the United States. That spurred some drops in pricing and the NAV of mutual funds, which spooked some of the ETF money out of the market. But because the high yield market is in such good financial condition, the balance sheets in the United States of the corporations that issue high yield debt are very sound. Leverage is low, interest coverage, meaning their ability to service their debt, is very high and very strong. And if we think about the outlook and where defaults are, defaults driving spreads for high yield bonds, that outlook is extremely positive. We have so much refinancing behind us. Companies have come to market and refinanced higher coupon bonds with lower coupon bonds. That is set to be in very good condition. There's really no risk of them defaulting anytime soon. And with the backdrop of second quarter earnings being so constructive, we also have the fundamental layer of improving growth within many of these issuers. When you transfer that to convertible bonds, the same holds true. Earnings have a much bigger impact because the stock prices are going to be driven by those earnings and those earning outlooks. It is not universally true, of course. What we are seeing is sound participation of investors within the, call it, PE ratios when they're thinking about the valuations of these equities. In many cases, they are buying the company's growth rate. That has an impact on high yield. That has an impact on convertible bonds. Clearly, it has an impact on the stocks. If we see a company miss in the current market environment, let's say they lower growth by 20% in their earnings outlook, the stock can fall 20%. So investor prediction of future earnings expectations is critical for where these prices are going. Us as investors at Allianz Global Investors, we are clearly focused on those companies that are doing well today, should be doing better tomorrow. When you combine many of these factors, the outlook for high yield bonds, convertible bonds, and equities, with the backdrop of an accommodative Federal Reserve and an accommodative governing bodies, regardless of where they are in the world, that are accommodative, those that are lending investors confidence in the financial markets, those that are going to lend themselves to an environment of better growth. As a matter of fact, many market observers, many strategists today have taken up third quarter GDP forecasts in the United States from 3.5% to 4%. We're actually sitting in a very unique environment of accommodative growth with many companies, especially within the United States, reporting very good earnings. It is good for many of these investment tools for investors that are looking for not only growth in equity prices, growth in their ability to earn, but also not be harmed by other interest rate factors that could be spooky. Many of us entered 2014 thinking that rates would at least stay stable, possibly even rise, as the Fed was less accommodated in the United States. That clearly has not happened. We're in a unique environment. It's one that investors should not be looking at with fear. They should be looking at with optimism. We as investors today, knowing that the outlook for earnings can be volatile among different sectors, we have to be very nimble. We have to be active. It is a stock picker's market, if you will. We have to do our homework and make sure that the companies we're looking at are going to achieve, at least meet or exceed expectations over the next 6 to 12 months.